It's a pleasure to welcome you all to this BiG Talk conference that will address best practices and key trends affecting family businesses and family offices. To partner on this initiative, BiG invited three institutions with a strong track record and experience on this area, namely the Cambridge Family Enterprise Group, represented here by Mr. Mário Marconi and Mr. Alexandre Dias de Cunha, both senior advisors and associate partners for this group. The Portuguese Family Businesses Association, represented here by its president, Mr. Peter Vilax, and the law firm Abreu Advogados, represented here by the private clients partner, Mr. Nuno Bernabé. We are very grateful they decided to join this event and share some of their knowledge and wisdom with us. Family offices had a great development over the last 2 decades. As a reference, the 2019 Global Family Office report by Campbell Wells noted that 68% of the family offices surveyed were founded in 2000 or later. And the same entity estimates that the number of family offices has risen 38% in the last 2 years. Part of the reason for this increase is the rise in worldwide wealth over the last 20 years. Phenomena like the proliferation of successful startups have extended the ranks of the billionaire population. Of course, unicorns are no longer just fictional creatures. The motivation to set up family offices is often based on the increasing complexity that families face today when managing their affairs in relation to financial investments, risk management, legal and tax matters, philanthropy, and several other issues. In particular, we are now currently witnessing increased complexity on managing financial assets due to low interest rates, volatile financial markets, and unstable geopolitical conditions that may require an improvement in investment expertise and sophistication. Additionally, the pandemic crisis triggered risks that many weren't neither aware nor prepared to handle. Other trends requiring family office attention are succession planning, the growing globalization of investments, and also the increasing exposure to different jurisdictions as family members decide to study, work, and settle abroad. In Portugal, we are also seeing the growing sophistication of family offices with distinctive approach on some key areas, including a higher dependence and integration between the family office and the operating business, with the rising complexities, of course, on managing both in a challenged economy, and the higher use of the multi-family office approach due to the lower average size of the family office. But we are also seeing opportunities because Portugal is well positioned to attract family offices. It has an interesting framework and residency schemes. It has excellent safety and quality of life, and it also has a dynamic IT ecosystem together with innovative companies to invest. BiG, as an investment bank, serves both family businesses and family offices. We also cooperate closely with several multi-family offices and have a solid and sustainable business model. This allowed us to enter the Spanish market last year, focusing our services in wealth management and corporate finance, and also preparing to serve all these target clients on that market. But our main goal here today is provide some food for thought for families and family offices with respect to relevant trends and how to prepare for the future. We hope it can be useful. Now, without further delay, I will hand over the presentation to our keynote speaker, Mr. Mário Marconi. Mário, please go ahead, and thank you very much.
So also from my side, a very warm welcome to this webinar. In the next 30 minutes, we'll try to shed some light on this very secretive industry of family offices. But before doing so, let me briefly introduce myself. My name is Mário Marconi, and I represent today Cambridge Family Enterprise Group, an advisory, education, and research firm founded by Professor John Davis over 30 years ago. Professor John Davis, originally at Harvard, today at MIT, has been one of the pioneers in the field of family business, the first one who in the 70s at Harvard started studying family businesses as a subsegment of business in general. In Cambridge, we focus in advising families, providing them advice, education, helping them be successful in the long term in areas around the family, from family strategy, governance, next generation, and a number of related topics. The topic of family wealth in that family office in that context has grown significantly in the relevance of the work we do over the last decade, in particular in the last 5 years. We see more and more families coming to us for support in helping them deal with this very important, strategic, but complex topic. Personally, I have a financial background, 25 years of bank, and I also run the family office practice for UBS for a number of years. Now, to tackle the topic today, we'd like to separate the presentation in two parts, giving you first a macro view and then a micro view. First, giving you a bit of the landscape of that industry, what this is about, what's happening, what are the trends, also what is happening, what are the main challenges, and from there also looking a bit into the future, what we see in terms of new models for family offices in the logic of the new economy. And then I'd like also to focus on giving you micro view, addressing two very operational questions about what to consider if you have a family office when thinking long-term success of the family office, and on the other side, what to consider if you want to set up a family office. So a lot to cover in 30 minutes. You will allow me, unfortunately, we'll need to stay a bit generic and certainly not market specific, but I'm sure we'll go more into the details when we go into the panel discussion later. So without further ado, let's get started. And I'd like to start with providing a definition of the term family office. Why is that important? Because the term family office has been overly used and inflated. And I'm sure if we would ask the audience, we would get many different definitions of what a family office is. And as you see on the slide, this is our definition of family office. It's a private office that does provide a number of services to a family to help them manage their financial and family affairs. And typically these activities can be organized in 4 buckets, starting with investment management, which is often at the core of what family offices do. It's about managing, portfolios, strategic asset allocation, manager selections, reporting, etc. As I said, the vast majority of family offices have that activity as really the center. The second bucket is around legal and tax. It's about administrating, managing the wealth structures of the family, from holding company, trust, foundation, whatever the family has in place, also looking at tax strategy, estate planning, etc. This is traditionally an overlooked area in families and family offices. But we're strong believers this is an area where families need to put more focus on in the future because of wealthy global families, which by definition are multi-jurisdictional, and in addition, a fast-moving and complex legal, tax, regulatory environment. The third bucket is around administration, lifestyle services. This is about helping the family manage its operations, goes from services like accounting, reporting, concierge services, security, healthcare, what have you, whatever the family needs. And the fourth bucket is around more strategic activities of the family, helping the family manage its strategy, long-term strategy, manage its various governance bodies, like the family council, owner council, communication in the family, talent, next generation, we look at that as, you know, the corporate office of the family, like you have a corporate office for the business. So as you see, a vast range of very different activities requiring very different type of expertise and professionals to deliver on that. And so the next question is, how do family offices get organized to perform this type of activities? And the answer is that family offices come in very different form and shape. And as the saying goes, when you have seen one family office, you have seen one family office, meaning that you know, there's very different varieties of family offices. Having said that, you can group the typologies of family offices in three different categories, starting with the informal family office, which is an informal structure where basically the activities we're talking about before are performed by people around the family, either inside the family system or outside, but are not organized in a formal structure. So typically is when, I don't know, for instance, the CFO or accountant of the family business also looks after the private wealth of the family, or the legal team of the company also looks at the legal structures of the family. And this is typically the starting point of family offices when you do the first step by organizing and formalizing this type of activities. The second model is called multi-family office, and this is about a commercial organization which provide family office services to families. So in this case, the family would not set up its own family office, but would become a client of a multi-family office which would provide all those services to the family. And the third and the most well-known is the single family office, where the family sets up its own platform to manage its affairs. As you see, different models, there's no right or wrong. It's all about matching what the family needs with the right type of platform. We'll come back to that later in the discussion. Now, if we look, take a bit of a higher perspective to this and look at the family office industry, it's important to say that that industry faces a number of structural challenges. First, it's a very intransparent industry. There's very little data available. Mr. Mario Bollotta was mentioning before the Camden Wealth Report, which is one of the most qualitative pieces of data in the family office space. But beyond that, there's a lot that you will find lots of reports, a lot of contradicting data. So it's very difficult to grasp the market. Which is in reality a jungle of operators, as I like calling them. The second challenge is family office is today very fashionable. Obviously, it goes together with what Mario Bollotta was saying before, i.e. there's a growth of wealth, growth of family offices. This is a very interesting platform, and everybody is talking about that these days. And what we see, particularly in the financial services industry, there's many investment firms which are relabeling themselves into family offices, which again creates additional confusion to already untransparent market. And last but not least, I would say this is the most relevant item. The industry is not regulated, there's no standard, no benchmarks. All this makes it very difficult for families to navigate that sectors. And we see it ourselves in the kind of work we do with families, where the number one question that families that have a family office have in the back of their mind is, am I doing okay? You know, do I get the right performance from my family office? Am I paying too much? What are the best practices? What are other families are doing? These are important questions and difficult to answer because of the structure of the industry. Moving on and looking at what is happening, what are the trends in that market, and what we see and what we have seen. And take the last financial crisis, 2008, as the starting point. At that time, many family offices have been caught short and suffered tremendously in that crisis because they realized they didn't have the right infrastructure to be able to perform in difficult environments. So since then, what we have seen is a very slow, discrete, but profound transformation of the family office industry under the label of professionalization. Family offices are becoming more professional, more structured, more disciplined in running their operation. This has led a number of trends in the market, starting with growing operating costs. It is estimated, and again, take all these numbers with a grain of salt, that running a family office costs over 1% of the assets that the family office manages, if you take assets as a parameter for measuring cost, which is what many people do, but the number has been growing significantly over the last 5 years. The second trend, which is linked to the issue of cost, has been the outsourcing of more activities. Traditionally, family office are very secretive organization and they tend to do everything as much as they can in-house. That's been the old world. First, to protect the privacy of the family, and second, also for cost reasons, sometimes with the wrong assumption that if you do things in-house, it might be cheaper than doing them outside. One good example is the topic of consolidated reporting, which for us is one of the key components of infrastructure that every family office needs to have. A tool allowing the family office to consolidate all the assets that the family has across banks, managers, what have you. Bring everything in one picture of an overall portfolio of the family. In the past, many single family offices have been building their own infrastructure to do this type of reporting, either by building their own IT platform. Some family offices have done that in the past, or just by having people running Excel sheets and bringing their portfolios together. Today, you have in the market top quality firms which just do consolidated reporting as their business, and the family office can use the services for a fee rather than building the infrastructure in-house, which brings a number of advantages. Again, as one example of the type of outsourcing that family offices are doing. There's also more openness to partnership and collaborating. In our view, this is due to two reasons. The first one, the new generation is more open to partnering than the previous generation. And second, also for cost reason. And so we see collaboration happening in two sides of the value chain, either on the structural side, in families getting together to share costs, sharing platform, rent, IT infrastructure, what have you, but also families getting together, sharing deals, the whole world of club investing and co-investments and club deals, which is a topic per se we will not really cover today. Also, in that same trend, outsourcing, we see a more active delegation of certain investment activities, to professional investment firms like Mario Bolota was referring to earlier, because of the complexity of the investment world today and the cost to build your own platform. I'll come back to that later. So, all to say, in the last 10 years, there has been quite a profound transformation in the family office world. But then COVID hit. And what was interesting to observe, and this is what we observed in the last 12 months, that still, despite this trend, many family offices have again been caught short. And some of the observations we have made are here on the slide, starting with many family offices not being ready to work remotely. Too much paper-based, not enough remote and digital platforms, which has led to some family offices being unable to operate in the worst moment of full lockdown. Also, an issue which has popped up in line with what I was referring to earlier, the more outsourcing of activities, have been issues with providers, which have also might have been hit by COVID, might have gone bankrupt, whatever. The point is, it's okay to outsource, but then it's important to do proper due diligence on the providers that the family office is going to use. The third aspect, which I'm sure many of you will be familiar with, is what I would call the dual family office staff. These are, particularly the more senior staff and executives around the family who have a role both in the family business and in the family office. And in moment of crisis like COVID, obviously what you see is all attention goes to business and the family office get neglected, again, making the family office suffer and struggle in performance. In our view, the main topic which is still on the table of many family offices is risk management in two areas. One is investment management. I was talking about consolidated reporting as one of the core pieces of infrastructure. We see still too many families which are not able to get together in reasonable time their market exposure. And when you face markets like the last 12 months, you cannot wait 2 to 3 weeks to know what your market exposure is. Unfortunately, this happens more often than what you think. This is the first area where we see risk management is often not under control. The other area which we see emerging and we believe will represent potentially a serious issue for many family offices in the next future is around security. IT security, data security, privacy, in some cases also physical security. Family offices traditionally underinvested in this area. Again, I'm making very generic statements. There are fantastic family offices which have everything under control, but we see there's a big chunk of family offices which don't have those key components under control still. Another worrying trend we have seen is the disconnect between the family office and the family. It's an interesting phenomenon that we have observed over many years. The moment the family office as an executive team which is not linked to the family, and the family does not remain involved in the family office, you start having that disconnect, and the family loses control in a way, losing the oversight on the family office. And again, in moment of crisis, obviously, I don't need to tell you, this becomes a challenge. Having said that, we have seen some family offices very well positioned to take and capture all the market opportunities that a crisis moment like COVID was bringing. So, all to say that there is a profound transformation taking place in that industry. Family offices are adapting to the new world, but the new world is here. And we live in what some practitioners call a VUCA world, a term which I discovered recently, but apparently has been around for over 20 years. VUCA standing for volatile, uncertain, complex, ambiguous. And this is the name of the game in business. We know it. This is reshaping the way we do business, but this is also going to reshape the world of family offices. Family offices need somehow to reinvent themselves to be ready to tackle the challenges of the 21st century. And what do we see as the main challenges that family offices have to face today? You see here on the slide, at least what we believe are the 5 most important, starting with so-called critical mass for efficiency and effectiveness. What is the right size to ensure the viability of a single family office in terms of assets or wealth that the family office needs to manage, but also the size of the family. What are thresholds? There's many people saying that below $500 million, a single family in terms of invested assets to be invested. Building a fully in-house single family office does not make much sense. But again, this is just one of the variables that need to be taken into consideration. So that balance is one challenge that family offices face. Talent is probably one of the key issues or challenges that family offices face, i.e. the family wanting to have top professional in their family office, but often not being ready to pay market price for the type of professional but also often disconnect between the quality and the type of professional they want to have and the mandate of the family office. So many family offices are struggling with that. Infrastructure, I already spoke about it. It's definitely an important item to make sure that you have, up state-of-the-art platform to run your operations. Governance, another key, key concern, key challenge. We see too many family offices not having the right governance, decision-making process to be able to move fast, swiftly, be agile, in particular in today's world and in the current market environments. How do you have the right talent on the table, the right professionals, and again, a very agile and fast decision-making process. Last but not least, direct investment. This is a hot topic. Private equity, or not via fund, but by directly buying stakes in businesses. There's many family offices running in that direction. Again, it's a very interesting field with lots of opportunities. But we see many family offices which don't have the right infrastructure to be able to do direct investments. Too many are just opportunistic, are not able to do proper due diligence, proper monitoring, and therefore are jumping a bit left and right in whatever opportunity comes to the table. And we have seen, and we believe we will see more family offices losing considerable money in doing direct investments. Again, direct investments are interesting, are a great opportunity, but like any other thing, they need to be run professionally. I was talking, to give you an example, recently to a Latin America principal of a family office, a considerable wealth on the table. They do direct investments. The families are entrepreneurs at the heart. They're running important businesses, but they also like doing direct investments. And the principal was very honest when I asked him, so how do you make your direct investments? And he said, to be honest, I was very lucky. We made some good money, but we were opportunistic, and the way we chose our deals, that's where he paused and then said, yeah, probably that's when the last advisor brought me a deal in which to invest. Again, not probably the most sustainable model to do direct investments. So you see there's important challenges on the table. And what we see emerging as an answer to all these challenges is what we call here the virtual family office, or actually what the industry calls the virtual family office. What is the virtual family office? Is in reality a combination of in-house and external resources, i.e. building a core team in your single family office with seasoned professionals who will set the scene, will set the framework, we define all the key strategic areas, but then you rely on external partners, providers to execute and deliver the services. In some areas of the family offices, we have seen that already as practice. If you take legal and tax, this is already the case. Typically, you see in family offices maybe one or two professionals, maybe ex-trustees or wealth planners who take care of this, but then the execution is done with professional trustees, tax firm, advisor, which work with the family office. The area where this is happening and changing with the landscape is in the area of investment management, where the model that is emerging is single family office working with multi-family office or independent advisors. So again, you would have in your single family office a small team of seasoned investment professionals. They define the framework, the investment framework, the investment strategy with the family, the investment governance, policies, committees, communication, oversight. But then they would partner with a multi-family office or investment advisor in order to provide the execution, leveraging what the critical mass that these investment management firms have, that the single family offices rarely has, and therefore cannot afford hiring top-notch CIOs and investment professionals cannot justify to do a systematic market screening of emerging managers, fund manager, hedge fund manager, private equity managers, and therefore relies on, on larger platforms to execute those services. The way this translates often is, for instance, in investment committees, where you will see, the more sophisticated or advanced family offices, you will have family members in the investment committee, the investment professional of the family office, but then also a CIO of an investment firm populating that family office with content, market insight, and also a rational and independent view, which also helps on the governance side. And there's a number of other services that, again, this investment platform can bring to the family office without the need for the single family office to invest. So we believe that this is so far a model which is growing, is emerging. More and more single family offices work in this partnership mode as an answer to make sure you have a state-of-the-art platform at a reasonable cost. Right? So this was my 15-20 minutes on the market overview, what we see happening. Let me now switch gears and go to a much more micro level and look at these two questions I was raising before. What to consider for ongoing success of a family office when you have a family office, or if you want to set up one. And let's start the case where you have a family office already. And the name of the game in this case is making a regular review of your family office. Seems obvious, but in our experience, doesn't happen very often. We see many family offices established 5, 10, 15 years ago, where the family office has not evolved, but the family situation has evolved dramatically in terms of maybe the size of the family and the wealth of the family. And what this creates, obviously, is a disconnect between, again, what the family needs and what the family office delivers. And that's why these reviews are important. And one should address very basic questions, starting with, does the family office meet our needs? Again, seems a basic question, but then when you go to the first question in that context, which is, do we know what we want from the family office? Unfortunately, often the answer is actually we don't know. And often the family office is there, it's taken for granted, but there's no questioning. Next is, do we have the right oversight on the family office? As I said earlier, we see this disconnect also as an emerging trend, which in our view is concerning. Where in theory, the hierarchy should be the family controls the family office, but often we see situations where the family becomes the, excuse me, the term slave of the family office, because they have lost grip, they have lost control on the family office. Again, the infrastructure, key question, don't go back to it. And then another obvious question, is the performance of the family office in line with our expectations? Are the costs in line? So these are very important questions that one needs to ask on a regular basis to make sure that the family office remains synchronized with the family. The family office is there to support the family, and therefore needs to be managed as professionally as any other business that the family runs. Now, if we move to the situation where you're thinking about setting up a family office, here the name of the game is simple: make your homework before you start. Again, sounds trivial, but we see also here families that start doing the steps without having done the full homeworks. I was talking recently to a principal of a family who has unfortunately exactly done that. They were overwhelmed because they had too many portfolios, too many banks, too much family complexity, and they felt they had lost control. They decided now to start formalizing the family office, and before doing the homework, they hired a professional, an investment professional, and then they started doing the work of what we need from the family office. And unfortunately, what happened is that they realized there was a total disconnect between the professional that they had hired and what the family needs, which is not the situation you want to be in. So again, addressing question before you start, what do we need from the family office and what are our goals? What is the right model? We saw earlier a number of different models. Which one meets our needs best? And then governance, core, central, make sure that you build the right governance around the family office, and then again, the right infrastructure. So again, trivial. The market tells us that unfortunately this is not happening as systematically as it should be. But also to keep in mind, the reality is that family office is a journey. It's like a business. You start small, you learn, you develop, you grow, you adjust as you go in your family office. So I'll conclude here by saying, family office is a very powerful instrument. We have seen this industry, as Mario Blotter was saying earlier, growing tremendously in the last few years. We believe there's going to be more to come. The model will change, the industry will adjust. There will be, I think, great positive development in terms of transparency. There's people working also on certifications for family offices, so that world will become easier to deal with. But again, it's important to do your homework. My conclusive statement is that the current crisis represents a unique opportunity for families to review their setup, their family office, and make it ready to navigate the challenges of the 21st century.
Thank you very much, Mario. Thanks for your excellent presentation. I think it provided very interesting topics and trends which are relevant also for domestic family offices operating in Portugal. And in order for us to further discuss these issues, I'm here with Alexandre Dias da Cunha. He's also a partner at Cambridge Family Enterprise Group, and he is leader of the Family Business Initiative at the Universidade Nova. And with Nuno Cunha Bernabé, he's a partner at Abreu Advogados and head of private clients in this law firm. Thank you, both of you, for joining us. And my name is Diogo Costa. Before we start, I would just like to remind the audience that after this roundtable, we will have the Q&A, which will be with moderation by Peter Villax. He is the president of the Family Business Association. And in case you want to submit any question, you can do it on the right-hand side of your screen. You shall see on the dashboard a line saying questions, and you can submit your questions either in Portuguese or in English. Okay, so regarding the topics that Mario Marconi gave us, it's very interesting noticing this growing professionalism, the growing challenges that family offices face all over the world. And I would say that this trend is also being followed by domestic family offices, although on average we have family offices with a smaller structure and sometimes with more links between family offices and the family business. So when we have in general family offices with a lower size of asset, one of the key questions is how to obtain the same performance and without too much costs. And when we look at international family offices, they mostly see the strategic asset allocation as their cornerstone activity. It is very usual to see the investment in equities as the primary asset class, and so they are taking risk, and they are doing it thinking on the long term, on the long run, a little bit as the family businesses usually operate. They are not players for the short term, but for the long run. It was very interesting to notice how Mario also mentioned that risk management is a key issue nowadays, and that many family offices need to address it. We see usually a trend and an increasing concern towards more diversification in the way family offices invest. Usually with a segregation on the exposure to an operating business, in which usually the family has some tradition and an accumulated know-how, and besides that, a preoccupation to be invested in several assets with exposure to several asset classes, and primarily with a low correlation between the investments in liquid assets and the operating business. Risk is in both. There is risk in both areas, both in businesses and in all other assets. But searching for this low correlation is key to navigate the uncertainty. And we are, of course, in a period of extreme uncertainty that is affecting still all of us. On top of this, I would say that the family office landscape in Portugal was during many years primarily occupied by Portuguese families that inherited or that developed several businesses in the main sectors of the Portuguese economy. And in the last few years, we had also the entrance of a relevant number of international families who chose to live and to settle in Portugal. In some situations, we feel that that movement is still being exploited, and Portugal is still regarded as an interesting place to work remotely in a post-COVID world. And also many family offices discovered Portugal and looked to Portugal as a destiny for their investments, specifically when family offices act in a similar way to private equity funds or to private equity investors. This generates lots of challenges, and maybe Nuno would provide us his view on maybe mainly the legal and tax implications, and Alexandre on the governance and the organization implications.
Okay. Thank you, Diogo, and thank you to BiG, and a strong welcome to the Associação de Empresas Familiares and to Cambridge. It's a pleasure to be with you here today. Before taking up on your question, Diogo, I think that I will, of course, try to contribute here to the discussion, trying to zoom in on the tax and the legal side for family offices in general, not only the domestic ones, but also the ones that have resulted from this huge mobility that we have seen in Portugal over the past years, of people and families moving all together, or certain members at least, to Portugal, attracted, of course, by the our golden visa program, but more importantly by our non-habitual resident regime. I'll go to that in a while. Probably I would suggest to start, and I think it connects to a certain extent to the question you raised, Diogo, with a question that we already got from the audience, which has to do with, which I'll read for the benefit of all the audience. Before 2008, family office goal was profitability without paying taxes. Today, the situation is different, that's clear, but is tax efficiency still essential? Well, the answer to that is, I would say, dual-fold. First, since 2008 until now, as everyone is aware of, the way that we as a society deal with taxes and taxation, and in particular the way that the wealthy people in society with taxation has changed dramatically. That is, in fact, and partially a result of the financial crisis in 2008 and the years after, in particular in Portugal, following the bailout in the early 2010, 2011, 2012. So today, taxes, I would say, it has become one among other factors. It is always important, and I would say that traditionally in Portugal and in cultures which are similar to the Portuguese culture, Spain, Italy, in particular in Europe, you can try to, well, I say that the amount of tax that you pay, of course, on your investment can make an important difference because you're in general exposed to the market, very specific market risks that you wouldn't find in other economies. So tax is always important, and culturally it is important for us. That would give a totally different webinar, so I won't go there. But today, whether or not a transaction or a management or a choice is tax driven has become a matter of law. As you all know, the EU in general has, the EU in particular, has a very aggressive program of tackling tax planning and abuse of tax law. Taxes have become, and let's say, managing taxes has become somewhat very conditioned from the legal standpoint, from the standpoint of the public policies of the authorities. So it is still in Portugal important, but it is, I wouldn't say that from that point of view has become essential. Managing taxes, in fact, has become also a reputational issue for wealthy families in particular, because it has to do with many things, in particular with the inequality or increasing inequality, the policy around that, and that justifies a number of public policies everywhere. It's not just, of course, in Portugal. And when you're advising wealthy clients on taxes, and perhaps that is the most precise answer I can give you, in 2008, we were, of course, just looking for the most tax efficient solution. No one was really very concerned on how, let's say, a more aggressive tax planning would be perceived, on the risk that they would have, even reputationally speaking. Now it's totally the opposite scenario. The first thing that we think of when we're discussing taxes and taxation on investments, on portfolios, in a family office, for example, on certain investments, private equity, and structuring of acquisitions, is, well, taxes have to be seen very carefully. There are limits to what you can do, and there are limits to the risks that you can have. I would say that this is an important aspect also of the profession and the lawyer's role dealing with family office that has evolved significantly, is that we have become much more the person to which the clients resort to assess legal risks and tax risks. So risk management has become really key in our work because of this aspect. So taxes is also a reputational issue. So it's not just the cost that's involved, it's not just the sanctions, which we didn't have in 2008, now we have. It is also the reputational impact that has in the way that the family or the family office or a certain person is perceived. Then I would close with something which is also important. As you've seen, there are certain movements internationally where actually we have, and some of them were active in the US election, where actually we have wealthy individuals which think that they should be taxed higher, they should contribute more. So there's also that aspect. Not everyone, of course, is on board with that, but that's something that's here to stay. On top of that, and I have that experience, if you move down to younger generations, in particular in the Anglo-Saxon world, you would see that in certain cases, and I have had that experience, where tax management or managing tax is not even something that they want to discuss. They will immediately instruct you, we don't care about the tax, you pay whatever taxes are applicable, so it is not even part of the equation. So the situation is totally different. It has evolved dramatically. Now it is, I would say, not essential. It has not essential. It is something that has to be properly managed. There are risks associated to it, and the risks sometimes weigh much more than, let's say, the return that you can get from, let's say, a more active tax management. Having said this, and I'll probably make 2 or 3 notes on family offices and the experience here in Portugal, and I think we can talk a little bit around that and hear Ocean in particular's opinion. We don't have, of course, a legal framework for family offices in Portugal. Most countries don't have it. There are exceptions, of course, to that, which is, for example, the case of Switzerland, which is much more sophisticated than everyone else in that regard for obvious reasons. So only part of the activity of family office is subject to certain regulation. For example, if we're dealing with multi-family offices or advising on financial transactions, of course, we're dealing with a regulated activity, which would be performed by an asset management company or by a bank, as is the case of BiG. That is, let's say, as far as the regulation goes. Other than that, it's pretty much what we call in the profession the private autonomy. Family offices are a reality that touches all or practically all of the areas of law. So there is, if you're dealing with the wealth management, then the wealth management is the issue of regulation, and you're dealing most likely with an external service provider. That would be the general reality in Portugal, as Diogo was mentioned. My experience is the same. But then, if you're dealing with tax and bookkeeping, of course, then that's something that you involve other professionals, and you would not, and it's not regulated, and you would not perhaps have that function inside. But then there's the issue of family governance. There's the issue of succession. There's the issue which is still where I think in Portugal we still have we've gone a long way, but there's still a long way to do, which is philanthropy, social responsibility, even administration and concierge services. All of that have to a certain extent a legal dimension and legal implications. Having said this, I would say that typically in Portugal, you would see that family offices, the professionalization of family office up to this point is very much linked to the asset manager. They tend to be perceived as family offices equivalates to some form of asset management or wealth management, all the other functions being, let's say, less perceived and less relevant. They are, however, from more experience, very, very significant. In Portugal in particular, as you know, we are experiencing the first real generational transition between the heirs, between the founders and the second generation in this case. That's what's been going on over the past years. It has to do, of course, with our own history. And it is a very, and COVID has, to a certain way, enhanced those concerns. Most of last year nowadays, the main concern of wealthy clients and family office and their owners has been, of course, with succession, wills, generational transitions in businesses, to a certain extent, asset protection. Those which have been less concerned with that, or for the reason that they belong to younger generations, have been preparing the field for the opportunities that will come. Private equity, alternative investment. That's the real, I would say, competition with the financial sector and the traditional wealth management.
Nuno, may I bring up the question of time? Question of time, yes, please.
Okay. Sorry, Peter. Just to try and pass the word to Ocean, we were discussing this the other day when we were preparing this webinar, which is the following. In most situations, when clients approach us to deal with typical instruments that you have to deal with a family office, bylaws, shareholding agreements, wills, clients are not very much concerned. And we ask them the question, okay, what is your long-term objective? What is the impact on the family? These are not questions that in Portugal clients are very used to. They're starting to learn how to do it. So this type of approach is really very fundamental in family offices. There's many things that are more soft law regulations, internal regulation, rather than actual legal instruments. That's much more of that going on. So I'd probably be interesting to hear Alexandre's experience on advising the family office on governance matters in particular.
Very good. Yep, thank you. So a warm greeting to everybody. I'll start with the audience out there that I cannot see, but of course also my fellow panelists and organization, and Peter Vilax, of course, whom we've just heard from the background. So hello to everybody. A first note of thank you for, first of all, to Mario Marconi, my colleague at Cambridge. He is one of our practice leaders in this field of family offices. And I'm convinced that bringing him to this, let's say, Portugal connected audience that we have today is certainly a valuable endeavor. And my second word of thanks goes to Diogo Costa in particular. We've been discussing having this event for a number of, I'd say more than a year now, and I'm very happy to see it finally come alive. My opening remarks, I'll focus, so I come to this panel as the family governance guy, let's put it this way. This is what I deal with in various facets of my professional life, and of course also with Cambridge. I want to start focusing on something that some of you may perceive as a little bit out there, maybe philosophical, which is this: when we work with families, we often come across this, what I call a paradox between individuality and collectivity. Okay, so there's a tension going on in families that are in business and who have family offices. How much do we want to do together to manage collectively? And how much do we let individual family members decide for themselves? Family offices, of course, are a clear instrument of collectivity, and that is for good reasons. There's a lot to be gained in pooling your wealth, not just your wealth, your ambitions, your activities, for many reasons. As I said, in the case of family offices, of course, for economies of scale, there's much more that you can do together as a family than if you're investing individually, of course, and also access to expertise. But ideally, this should be done out of conviction and at the same time leaving space for individual development as well. And we like to remind, or I do at least remind families of something that this author many years ago called, Stephen Covey coined the 7 habits, if you remember that, some of you may. He talked about this phenomenon where we as individuals learn to move from a state of dependence to one of not independence, but interdependence, as he called it back then. So dependent people, they need others to get what they want. Independent people on the other extreme can take everything into their own hands and decide by themselves. But really the most efficient way or effective way of dealing with others is the independent mode, where you join your own efforts with those of the others to achieve greater success. But this, of course, requires a lot of communication. This is where, as Nuno was just hinting, family governance comes in. And one of the things we like to remind our families that we work with is of the importance of making sure that family members develop these patterns of interdependent behavior. So a little bit of philosophy to start with. The second thing I'd like to point out is we have this remark at Cambridge. We like to say that businesses may come and go, but the families behind those businesses and their wealth, of course, that can endure for many generations. And in practice, this can mean different things. It can vary a lot. Some families actually will stick to their core operational business for many generations successfully. Other families will divest from one operational business to invest in new ones, while still other families will adopt this purely financial investment driven approach, which in the end will result in a family office typically. There's also, of course, combinations of these different solutions. No matter which path you follow as a family, if you want to endure throughout generations in a sustainable manner, we like to think of paying attention to three particular factors when it comes to family governance. First one is growth. You need to grow your financial assets, your wealth, at least as fast as your family is growing. And this can be tricky because families tend to grow exponentially over time. And Nuno was mentioning the fact that here in Portugal, we're seeing this trend from first to second generation. But of course, we have many families already also here in Portugal who are on their transitions from third to fourth, for instance, or even more than that, right? And this is where you get what we call cousin consortiums with, say, 50 cousins owning things together, whether it's the operational business or the family office. So growing your assets at least as fast as your family is growing can be a challenge, and it needs to be focused on. Then the second factor is talent, which was also mentioned by Mario Marconi earlier before. So building useful talent, and let me qualify this. Useful talent is not just good CEOs for your operational business or good people to work in the family office. Useful talent is being, we like to take this very broad view, being contributing adults. Being a father or a mother, full-time maybe, that can be a contributing way to help your family endure for generations, and it requires talent. The second distinction I want to make is between family and non-family talent. There's no way that as you grow and pass generations and the world gets VUCA, you have a family office, you face challenges in your operational business, all that requires talent, and you cannot think that you're all going to do it by yourself within the family. So you need non-family talent. That's crucial. And you need to learn how to do that in the best way. So growth, talent, and the last one is unity, sticking together. People tend to confound unity with, oh, we love each other, we spend time together, we don't fight. When we talk about unity, we mean unity of purpose. It means knowing why you want to be together, what you want to achieve together. So growth, talent, unity, you need to be good. You don't need to be persistently good at all three factors all the time. But if, on the other hand, you're weak on all three factors for quite some amount of time, that's pretty much what we say end game for that family. So have momentum, keep working on these three things. And we like to think of it like a mantra: growth, talent. Get up in the morning and think growth, talent, unity. Growth, talent, unity. That helps. And family governance, just to conclude, will go a long way to keep you focused on these three factors. So I hand over to
Thank you very much, Chandra. I think we will hand over to Peter Villax and start with the Q&A, as we have some questions also from the audience.
Yes. Excellent. I have here a number of questions on your very, very interesting presentations. I'm going to ask you to keep your answers to about 2 minutes maximum, which means that 3 minutes, I'm going to say something about you being too long, okay? But I really want to involve all of you. So starting with Mario Marconi, you gave 4 goals for family offices: managing investments, advising on legal and tax, administrative and lifestyle, and then the 4th is the one that really interests me: strategic family activities, vision, long values, long-term goals, governance. Now that is very, very different from managing investments. It's dramatically different. So tell me, how does this function, which for me is extremely important? Strategic family activities, how would you fit it in a family office?
You raise a very interesting point in the sense that, as you say, it's all about, where is the family office positioning in the hierarchy of the family, right? So traditionally, it was an investment house doing also other things. We see more and more families using the family office as a strategic platform, as I was saying, the corporate office of the family. Families don't have anybody around them to deploy their strategy. Where do we want to be beyond the business as a family? How do we run? They have governance forums, owner council, family council, next gen, whatever they have nobody running that for them. So that's what we see some family offices venturing in this direction, using the family office. That only works, I think, if you have the right talent and the right professional in the family, which is very close to the family. That is really the way it will happen. Otherwise, if you just look at an investment boutique, it won't happen.
So they're not family because they're professionals, but they're not completely anonymous bankers. They need to be very, very close to you.
That's the name of the game. Yes.
That's the name of the game. Another question for you from the audience. Family business and family wealth, should they be managed separately?
To me, there's no right or wrong. It's all about how you look at it from a perspective. And I'll give you 2 examples. It goes back to how you look at your business. Families, which are typically, the model is the main asset of the bank, of the family is the business, and then there's a chunk of money, right?
Yes.
In that model, typically you see that separate. However, in the model where families have a portfolio of businesses, not just one business, maybe 2 or 3, then it makes sense, and then we see family offices playing also the coordinator for the other businesses of the family beyond the wealth.
Yeah, let me go deeper into that, because typically families are built around one business. And then the business goes well, it produces dividends, you accumulate assets, and you need to do something. And in terms of risk diversification, you're not going to put it all back into the business, you're going to put it somewhere else. So you clearly have 2 different directions. There's the core business that has its core professional team, and then suddenly there's this new activity because you need to do something with the money. So how do you deal with that?
Typically, you see that in general, as you say, as the business is 80% of the wealth, I simplify, but that's a good approximation, and then you have a chunk of money. The professionals you need are different, and what you want the family to focus all the efforts on the business. Why? Because this is typically where you get the highest returns, right? And then you have a bunch of money on the side that you want to manage strategically in the context of your total wealth, right? So that is where, in general, I would say you don't run the things under the same roof, because the professionals are different and the strategic relevance is very different.
Excellent. Thank you so much, Mario. Diogo, on to you. It's a very different world today. In 2008, perhaps you didn't ask too many questions from your customers where the money came from. It's very different today. Today, we have anti-money laundering laws. We have prevention of terrorism laws. We have very, very strict know your customer regulations. And yet you, as a bank, you continue to need customers, you need to accept their money. How do you reconcile the old ways with the ever-present needs of running a business that needs customers and you need their money?
we reconcile fulfilling, of course, the regulations and the laws, and accepting all lawful situations, and eventually rejecting some. But I would say that this is a challenge for family offices all over the world, those who change jurisdictions, and those who need to be prepared to work in several jurisdictions and to be accepted everywhere. There is a higher cost for fulfilling regulations, but afterwards the business goals, the advisory to investors, the purpose of the family offices, and the role of advisor is similar to what it used to be in the past, and the interest of the investors and the families is the last goal of the relationships.
Jörg, that was beautifully answered. Thank you very much. Now, since you're organizing and sponsoring all of this, I want to give you an opportunity to give a pitch for your bank. What is your unique selling proposition in a business that has very little differentiation? Why should I come to your bank and give you my money to manage?
We are basically an independent institution, very solid, and we have just tried all over the time to put our talent and our resources to best serve our clients. So that would say are our principles, our model, what we believe in, and I would say our principles which are valid nowadays as they used to be in the past. On another topic, we have been working for a very relevant number of years with family offices, with multifamily offices, with advisors in Portugal, nowadays also in Spain, and investing more and more in digitalization, in technology, in reporting situations, aggregation of portfolios, a number of innovations that I would say were important before COVID and nowadays are increasingly important.
Thank you, Diogo. Well done. Alexandre de Cunha, another question from the public. We build our family businesses and we're thinking about the long term. Then suddenly we have a sum of cash to manage, to invest. You know, it's dividends, the proceeds from the family business. And then suddenly we have these hotshot fund managers and they want to give you 5, 6, 7% a year, or maybe place a little bit in a hedge fund, you know, to have some fun. How do you reconcile this, your hotshot finance managers with the long-term sustainability goals of a family?
Good question. Thank you, Peter. Well, first of all, let me say, I think that's already what I call a good problem to have, right? Because you're in a situation where you have suddenly, you know, a decision to make, and but it's based on having rather than not having, right? So that's the first remark I'll make. I think it goes back to a couple of things that were said before. You as a family want to typically think, as we say, in terms of generations, right? So you want to do things that will benefit not just you and your immediate descendants, but you want to leave something for those that will come once you're long gone, but will still carry your blood and your name. So that's like the whole driving force behind family businesses. So if you want to manage for the long run, you need to have a clear vision of what you want, and that includes what you just mentioned, which is risk-taking, right? So risk-taking, of course, has two sides to it. One is you need to take risks, especially nowadays where you have traditional investments which just don't pay off as they used to. So you cannot just say, well, I'll put this in a bank deposit and it will give me a safe return, I'll be happy. That doesn't work anymore. So risk needs to be understood, and most of all, the family needs to come to a consensus about how much risk they are willing to take. And that takes difficult conversations that need to be structured and that need to happen inside the family. And of course, not in the presence of that hotshot fund manager that you mentioned, because you want to be in front of that fund manager once you have that discussion already established, so you can set clear paths and objectives and boundaries in terms of how much risk you're wanting to take. And once you have that discussion inside your family, it's much easier to guide those people that in the end, of course, want to help you, but have, of course, also their own personal interests and agendas.
Elshand, interesting follow-on question from the audience, this time from François Pinango. I mentioned him because he's a friend of mine, and he's got an interesting question here. Is what should be the involvement of family members at the family office level? You know,
Thank you.
we tend to look at family offices as very professional organizations, but they should not miss the link, forget the link with the family. So what should be the involvement of family members? Give me an answer in 60 seconds so that we can
60 seconds. So, okay, I'm very happy somebody asked that question. So thank you, Francois, out there. I think Mario mentioned the challenge, which is the rising disconnect between the family and the family office. You need to have that connection. In my view, though, it's the family's responsibility to rise to that challenge. Families frequently underestimate the role they play. So it's up to the family to get organized, to invest in governance, and to create a family council. A family council that knows what it's doing. Once you have that, then you can start working on that connection. And there are things you can do, like considering common membership. So yes, you can have family members, family council members doing something at the family office. Of course, I'm not saying being, maybe you have that in your family, but most families won't have that. You don't have somebody who is savvy in terms of investments, in terms of how to run the nitty-gritty of a family office, but you can sit on a board and be involved in decision-making. And decision-making doesn't necessarily mean taking the decision. It can mean being listened to, giving your advice, your opinion. So that's one thing you can do. The other thing is reporting. What kind of information do you want to go from one direction into the other? It goes both ways. The family has to inform the family office, but the family office also has to report back to the family. You should think this through and have this established. And then finally, I've said it, consider what kind of involvement you want to have in different decisions. Maybe if it's above a certain level in investment, you don't want the family office to decide that by themselves. You want to involve the family. If it's lower kinds of investments, you can let them. So there's many things you can do, in fact. 60 seconds is not enough to ask more.
Thank you. Thank you so much. Going over to Noon Bernabe. Noon, this morning, I didn't read it all, but I read the most important parts. An investment agreement was 220 pages long. And I was full of admiration for the lawyer firm that did that. We tend to think that this work is impenetrable. I just want to say how important it is, the work that you do, so that things run smoothly. And how much I admire your profession at the end of reading that agreement. And mainly, but this is beside the point. I'm just saying how important you are for family business. If I were to come to you, and I'm not too sure about my priorities, I've worked hard all my life, I have some money to invest, I want to make sure that my kids are able to see it, I want to make sure that my wife is well taken care of. What is the advice? How are you going to structure the advice that you're going to give me?
Well, it's fortunately a common scenario, although the question is very pertinent and rarely put forward. I take the view that what, for example, we're doing here speaking with the people and involving, if necessary, a multidisciplinary team which is experienced in understanding what drives the family in the mechanism that govern is sometimes very important. My advice in those situations is ask the questions. That's where I start. It is very common that people will go there, and most often than not, they're expecting that I would propose, let's do a will, let's set up a holding company, let's organize a service agreement or a shareholders agreement. I start with the questions. I think that's the fundamental part. What are your concerns? What are your concerns long term? How do you view, and that's the most common situation, the business? Do you want to continue it? Who is there to do it? How do you connect with that? What are your, and based on these objectives, and sometimes they are not very clear. People are not used to getting those questions from the lawyer. They're just expecting to go there and, can you draft me this? And then I cannot really draft unless it's something absolutely very clear in their mind. Drafting a will or organizing a shareholders agreement to take into consideration certain concerns without knowing exactly what are the concerns or are the objectives and speaking with the people is something that you just cannot do. But it does require, I would say, certain skills and an approach which is rather less technical. I think the technical part, I often say that to my clients, the technical part I think is the easy part. There aren't a lot of instruments. If you're working with the right firm where they have the competence, they have the skill, that should be a given. But actually deciding what is the best tool, what you should put there. Sometimes the best solutions are really quite simple. Sometimes a shareholder agreement synthesizes and avoids creating a very complex structure. Sometimes a simple will is enough to put the mind of that client at ease, where at a moment where he is not quite sure of what he wants to do with his money because he's still involved in the business, is not very confident on whether their children is going to continue or not. Curiously, and I've mentioned that before, one of the things that I've noticed was most positive during this last year since COVID is that most contacts and most clients have become more aware of this concern. They have started to think about the future, their future, the future of their family, what they're doing. It is in fact a very interesting time because we are all forced to look inside and to have a more long-term view to things. So that's where I start. Start by the questions, knowing who I have in front of me, what drives them, and sometimes you would find there's all sorts of situations. I'll give you just one example of one which I'm in fact dealing with it now. I had a client which went with regular client. He's an entrepreneur, so basically his fortune comes from the business, well established, and they know that they have 2 children. They know that one of them, for personal reasons, are not very linked to the family. The other one is very much in the business, and it was very clear in their mind what they wanted to do. They wanted to protect the business going forward. That means, of course, attributing certain rights and the privileged position to the one that's involved in the business. But as you know, Portuguese law does not allow you it allows to a certain extent to do that. But that was not the issue that came on after 3 meetings. They thought they would have one and it would be settled. And then we started to talk about things we've never talked before, and we know each other for many years. And after the 3rd meeting, I was sitting with him, with his wife, which I recently met, and his wife was absolutely transformed in the sense that for her it was very, very difficult to take the rational decision. The other children would not be in a worse situation, would be compensated in some other way, but the idea that what they have built together would be used and they would privilege sunset. So this is the sort of things that you need to discuss and understand so that you're actually not creating a situation which sometimes generates more problems. All of this was very sensitive. Confidentiality is also a must.
It's interesting. You're as much a counselor and a psychologist as you are a lawyer. I was
You
very
need to be. You need to
interested.
be.
You need to be very interested by your answer when you said the important is not to have the answers. The important is to ask the questions.
Yes.
And I completely agree with you. I also liked your advice about simplicity. I think it's very, very good advice. Anyway, ladies and gentlemen, this brings us to the end of a most interesting session organized by BiG, BiG. Our thanks go to Mário Bolata and to Diogo Costa for organizing this. Our thanks go to the participation of Alexandre Dias da Cunha, Nuno Bernabé, and Mário Marconi. And of course, our thanks to all the audience. Thank you so much for having been present. Have a good evening.
Thank you.
Bye-bye.
Bye-bye. Thank you.